What are you seeing when it comes to the commodity market right now? I know you're forecasting a possible bounce, but what's going to be the catalyst for that bounce with all these headwinds that we're seeing?
Good morning, Frank. Well, it's first of all, we need obviously to see this market stabilize somewhat. We need to see China get its act together. Again, we need to see growth pick up there. We need to see the lockdowns start to ease. But then also, I think we need to see this quite extremely recession fear that has crept into the market over the past months. We need to see that start to tone down a little bit. Yesterday was very interesting, and I think we also just have to accept the fact we're into July, we're into the silly season where liquidity tends to dry out, and that basically makes these movements quite often quite extended. And reaction function, what we saw yesterday, really, you mentioned gas price in Europe, and that I think really started the whole thing. Gas prices surged higher, the dollar surged higher against the euro, and this strength in the dollar hitting a 20-year high against the euro basically was the trigger that sent the commodity sector as a whole sharply lower yesterday.
So a lot of concerns there. I know you called it a capitulation across all sectors when it came to commodities and things like that. We're talking about the dollar and the euro having parity, recession fears in the U.S., inverted yield curve, a lot of different things going on. If there is a slowdown, what commodities do you expect to be hit the hardest?
Well, I think at this stage, it will obviously be those that are most growth and demand dependent, which is the industrial metal sector. But we have to accept the fact that they have dropped quite significantly already. We're down to more than a year low, primarily driven by the weakness coming out of China. We obviously do not expect this weakness to last much longer. We will see a pickup in demand there, so that probably will alleviate some of the fears. Also, we have to accept the fact as well that the whole transformation is not going to die by what we've seen recently, because the move towards becoming less dependent on Russian oil and gas is very strong, and that basically means the green transformation will continue to require a lot of these industrial metals. So at this point, a real deep recession. Probably the oil market, but at the same time, we have so very tight conditions. So you can almost argue right now we almost need a small recession in order to balance the oil market thereby just keeping the prices at current levels.
I think you're the first person that I've at least heard say we need a recession. That might be a contrarian view, Ole. So just looking forward to Q3, a lot of different things going on. You mentioned it's the silly season when it comes to liquidity. So how does that impact the price of energy and the price of some of these industrial commodities? You're talking about things like palladium, platinum, et cetera. Also neon, also something that's really needed around the global supply chain.
It just basically means that in the short term, investors and traders are more focused on reducing positions and adding risks to their portfolio. And that's part of the reason why we're seeing this weakness. When we return on the other side, I think the market will obviously, first of all, look at the inflation threat, which potentially has eased a bit by the market's own actions. The FOMC is now almost predicting higher rates than the market is, and that also will attract some attention. But the fact that we are seeing yields coming down will also ease some of these concerns. So I think with that, the focus will return to the supply side, and there we still have structural issues, both in the mining industry, both in the energy sector as well. And I think these are eventually what will underpin the prices and will support higher prices into the second half.
So, Ole, I don't want to take you too far out your wheelhouse, but we have you just for another minute. You did mention in your notes that you believe that commodity prices, they might have an impact not only on our Fed, but central banks around the globe and their plans to hike rates. Where do you see commodity prices fitting into that? We've heard here in the U.S. it's all about inflation and also jobs, but you're saying commodities are also another factor?
Commodities, I think, is all over the inflation, because it is the rising input costs since the pandemic, and obviously accelerated by the Russian invasion in Ukraine, that has brought about these very high prices. U.S. is now benefiting from much sharply lower gas prices that will start to turn up in the utility bills over the coming weeks and months. And the food prices has come down sharply as well. So I think the lower input cost, at least for now, is going to take some of the sting out of this extreme nervousness about the inflation and the recessionary impact it will have.